Gautam, hi, good morning. Great to have you on the show. Gautam, once again, the West Asia crisis escalates, and you are seeing that spiral up on crude play out. Having said that, would you think this time would the markets may react a little differently, and we may not see a repeat of March play out? Should this escalate?
You raise a very good point because FIIs basically equate India primarily with two problems every year: monsoon and the price of oil. How's that's going to impact the economy every year? And this is, until we're dependent on fossil fuels, unfortunately, that's going to be a major issue. But if you think about it, from the start of the war, which is 28th of February, and then to the bottom of where the market hit, which was on the 30th of March, the drawdown was only 13.5%. And I mean, it's not a small amount, but the point is we've survived. This number is significantly better than a whole bunch of other global issues or accidents, if I can call them that, whether it's COVID, the China market crash, the GFC, the dot-com bubble burst, etc. So we've done actually fairly well. And I think a lot of that is thanks to the deft handling of our oil and gas imports by the government of India. So I think my point being that unless this escalates into something much, much bigger, and of course, that's going to impact the whole world, and including Wall Street. But my view is that we should be able to ride this out pretty well.
Gautam, given that there were two key triggers which were there going into the earnings season. One was the geopolitical race, which was coming down before we saw escalation coming in, and the second one was the monsoon. Now, do you think that the market would be much more cautious given that both the risks have re-emerged?
Here's the thing. With respect to domestic flows, they seem completely unfazed by any sort of global event, domestic event, what have you, right? I mean, I've said this in the past, but total penetration of the equity culture in our country is so low. The top five states, i.e. Maharashtra, Uttar Pradesh, Gujarat, Rajasthan, and West Bengal. I didn't realize West Bengal was in the top five. Now, of the total number of unique investors, that's 130 million or 13 crore in unique investors, top five states account for about 47.5%. These are NSE numbers. The top 10 states account for 73% of the unique investor base. So the equity penetration in our country is not even at the halfway mark. And the reason I bring that up is to answer your question, the money flow from domestic investors continues. And that's similar, by the way, not just in India, but in Korea, Taiwan, and Australia. Take a guess. You'd be surprised to hear this. The Korean market's dollar return year to date, not including yesterday's fall, but before, as of Friday's close, was 108% dollar return from January till last Friday. FIIs have pulled out $102 billion out of Korea. But think of the domestic money flow that's holding up the market and giving this kind of a return. So I think as long as we continue to have resilient flows, robust domestic flows into mutual funds coming into insurance companies, and of course, pension funds on their own investing, the DII pack is so powerful, I don't see the market necessarily correcting too much. And of course, the downside of that is I don't see the valuations correcting either.
Gautam, you're very good in catching on to structural themes. You've said a couple of times that AI, from an India theme perspective, the best way to capture it is through the infra story play out. We have seen a consistent rally on some of those names. Value still there, according to you?
So, you make a very fair point. Valuation is clearly an issue. If you look at the HVDC players, and I don't want to name them, but there are only three in the market, valuations are stretched. I mean, their own parents back in their respective countries are trading at maybe a third of the valuation, right? So I think that valuation issue is going to sustain in India, where I don't see valuations coming off until we see domestic flows slowing down, and or FIs, intensifying their selling, which seems to have taken a pause, at least so far this month. But I guess valuations are something which you'll have to grapple with and sort of digest. And as long as there's high growth, I'm talking of not 10, 15, 20%, that could be considered high growth in the Western hemisphere. But I think if you look at the growth rates that some of these companies are displaying, anywhere from 40 to 50% CAGR over the next 3 years, and reasonably good ROEs, I think these stocks are not going to get cheap, unfortunately.
Gautam, in that case, do you think the money would be chasing companies where you're seeing a good growth coming in? Because from the front line or the index point of view, the growth is not there.
That's a good point. I think you've got to be very stock specific, sector specific, and within that stock specific, because to the previous question about playing, data centers or AI in India, most of those companies are in the mid and small cap space. So you need to have the appetite to buy these stocks, which are, as we discussed, not cheap, and hold on to them for the next 3 to 5 years, and they will give you some spectacular returns. We've had 2 stocks in our portfolio, which were pretty small when we initially bought them, and thankfully they've given us a very good return. And some of them we believe will continue to give us a good return. So my point being that go find these companies and look at the overall ecosystem. And as I've said in the past, follow the capex trail, because in the absence of the overall macro not necessarily being super strong as it used to be, pre-COVID, I think the view is that you've got to go out there and find stocks where there's huge capex happening. I mean, both data centers, power, the capex is north of $100 billion over the next 5 to 6 years. So a lot of ancillary companies, component companies are going to be massive beneficiaries of this.
Gautam, curious to know whether IT has made the cut yet after the recent mega fall.
That's a very good question, Aisha. I think IT, it's been on our radar because every time we look at it, the stocks fall more. But let's look at the example of TCS, which declared results last week. I was pleasantly surprised to see that the number that they alluded to for AI revenues, and I think what the CFO Aarthi said is that every IT company classifies AI revenue, sort of in a different way. But the way they did it, they are saying that AI was almost 2.6 billion. That's their run rate. That's an annualized run rate, but that accounts for almost 8.5% of their overall revenues, which was about $7.6 billion for the quarter. So it's an impressive number, but the management did caution that these AI transformation projects are not the traditional multi-year projects that you've seen in IT services. They range from 3 months to 4 months to, in some cases, 9 months. So you've got to be cognizant of this. It's a step in the right direction, I think, and of course, specific to TCS. At least they've made a commitment to be getting in the data center business, which I don't see the other IT companies doing. So we've seen a rally in some of these IT stocks yesterday. I don't know if it's time to get excited about them. And valuations are very supportive. When would you get a TCS at 13 times FY28 earnings? So some of these could be interesting to look at, but we haven't bought them yet.
Gautam, a trend which started with TCS setting up their own AI infra data centers. Now HCL Tech is also doing the same thing. What's your view on that?
Well, I don't want to get into stock specific, but the fact is that if you've got the expertise and the understanding of the AI business, you've got, most of these companies have huge cash flows, don't know what to do with them. So getting into the future business, i.e. data centers, is the right thing to do. I'm not saying the data center business per se is a very high margin business, but the fact is it would be a very natural pivot for an Indian IT company to get into the data center business. And of course, with that, cloud and AI and all of that.
Makes sense. Gautam, financials, that continues to remain your mainstay in terms of the bet. Give us a sense. And what's keeping a lead with regard to allowing the financials to really run away, because you're looking at a multi-decade low of sorts in terms of valuations, at least on some of the names, some of the large names.
Yeah, no, you make a fair point. The reality is that you've not really made any money in, let's say, the private sector banks, whether it's HDFC, Axis, maybe with the exception of ICICI, I guess, over the last 5, 3 to 1 year. So you've not seen any major investor interest. What's ironic is I remember 7, 8 years ago at 4.5 times or 4 times price to book, HDFC Bank was the hot stock. Today at 1.8, 1.7 times 1 year forward price to book, the interest is limited. So that's, tells you how how fast the market can change its view. But I think at these levels, I think a lot of the bad news, if you can call it that, is priced in, and a lot of these stocks are starting to look pretty attractive. From a sector allocation for our fund, power actually is number one with a 21% sector allocation, followed by financials, which is 17%. So we've been sort of light. We played some of the NBFCs and gold loan companies.
Oh, interesting. Okay. So you've played it through NBFC gold loans. Any risk at all on the asset quality side over there, given the kind of fall in gold and, of course, the adjustment that's been made as a result of the duties? But any risk at all that you're seeing?
Not really, no, not because I mean, bulk of the loan book was given out at a much lower level. I mean, what's happened to gold in the last 12 months is abnormal, or definitely doesn't look like the new normal. So, I think, and of course, then the correction as you mentioned. So, we're not really concerned about the quality of the book.
On power, Gautam, you've probably latched on to some of these names at far lower levels, I would presume, because 20%, 21% is a large allocation to make. My guess is it's been the run-up as well, which has helped that allocation skew towards power.
Yes, it absolutely has. Like I said, we've owned some of the HBDC names that have run up so fast that it even surprised us. But I think the way to look at this, and again, from your viewer's perspective, is the transmission leg. So if I look at the three components of the power industry: generation, transmission, and distribution, the transmission leg actually is the weakest link currently. I mean, you could have the biggest solar park in the world in Khavda, which is in Kutch, but if you don't have evacuation of the power to where it's actually needed, i.e. to its customers, whether it's industrial or consumers, it's no use. So the transmission part, I think, and that whole ecosystem within the component ecosystem within the transmission side is going to be massive. I mean, massively benefited over the next 5 to 10 years as India builds out literally a whole new parallel grid. So my view is, stay focused on a lot of those names. Again, a lot of those component companies are in the mid and small cap market cap range.
Gautam, one sector which has been buzzing is the retail jewelry sector. We saw, a couple of stocks, and since you can't mention stocks, some of the stocks are running up in the last few days. How do you look at that sector?
We haven't focused on it. In general, we've been very light on consumer real estate, and also, I guess, banks in general. So we've shied away, and of course, IT as well. So we haven't looked at the sector per se, but since you bring it up, I think it's time to relook at them.
From a consumer point of view, which do you look at staples, or is there the discretionary spends which you are focusing on?
No, we look at anything that makes us money, and question really is timing. When's the right time to buy them? So going back to IT as an example, if you bought IT 3 years ago, haven't made money. You bought IT a year ago, you're really just about breaking even on some of these investments. So I mean, I just literally look at the Nifty IT index. It's down 40% in the past. I think August 2024 was really when it peaked. So near about 2 years. Look at TCS. You're down 55% on that stock in the last 5 years. So frankly, it's all about timing. And frankly, if now's a good time to look at some of these jewelry names, definitely put somebody on the job in our team.
Absolutely. So Gautam, other than the sectors that we've talked about, where else are you looking at opportunity or perhaps earnings revival this quarter?
I think the one segment, again, unfortunately, mid and small caps only, but it is going to be exporters. We have one exporter name, and I think the potential of India to enhance and double its exports, merchandise exports, I'm talking about, is humongous. I was in the States earlier this year, and I went to Costco, and I was very disappointed that within the clothing section of Costco, with the exception of one Nike T-shirt, I couldn't find anything that was made in India. You had literally China, Mexico, Vietnam, Indonesia, Sri Lanka, Bangladesh dominating it, even Jordan and Peru, a lot of Pakistan stuff available there. And I was just disappointed. I even went to other clothing stores, couldn't find anything made in India. So I think the opportunity set with all of these FTAs being signed, not just with the UK, which kicks in, I believe, day after tomorrow. Sorry, today's Tuesday, so starting tomorrow, the 15th. But my point being that a lot of these companies are undervalued, did get hammered during the tariff crisis with the US. But I think it's time to relook at a lot of these names.
Gautam, another sector which has been very muted is the cement pack. We've been talking of infra, but cement hasn't been that outperforming the other sectors. What's your view on that?
So I think cement is, again, a sector. We don't own any cement company. We've stayed away from that. And it's really a play on India's macro, right? And if you see the government stepping up in terms of its own capex on roads, infrastructures, if that happens, cement will benefit. The other big component of cement, of course, is real estate, which is doing, at least the build out has been massive. But if you look at the real estate companies themselves, they've been usually underperforming. So I think cement and real estate do go hand in hand, and maybe it's a capacity issue. We haven't looked at that sector in a while, but maybe it's more capacity, and it limits their ability to price these, price cement higher. I suspect it's that, but otherwise, the rate at which there's real estate development happening, and I'm not just referring to Mumbai, but on an all India basis, cement should be doing better, but we just haven't looked at that sector in a while.
Okay, interesting. Gautam, always great having you on the show and getting in all that insight.
Thank you.